welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Yeah, it's great to have you with us. Today, we're diving into a really interesting topic, the 1031 exchange.
That's right. It's a powerful tool for real estate investors to defer taxes when selling a property. I mean, who doesn't want to keep more of their hard-earned money, right?
Exactly. It's all about maximizing your investment potential. We'll break down what a 1031 exchange is, how it works, and some practical tips on how you can use it to your advantage.
And we'll also touch on some common pitfalls to avoid, because, it can get a bit tricky if you're not careful.
Absolutely. Plus, we'll share some real-life examples to make it all relatable. It's important to see how this can actually play out in your investing journey.
Yeah, and whether you're just starting out or you've been in the game for a while, there's always something new to learn.
For sure. So let's get right into it.
All right, Mike. Can you start by explaining what exactly a 1031 exchange is?
So, Sarah, when we talk about the 1031 exchange, it's not just some tax loophole, right? It really ties into what's happening in the market today, especially for folks over 40.
Absolutely. I mean, at this stage in life, many people are thinking about retirement, how to secure their financial future, and, protect against inflation.
Exactly. With inflation being a concern, real estate can serve as a hedge, right? It tends to appreciate over time, which is something you want when you're looking at long-term investments.
Right, and the 1031 exchange allows investors to defer those capital gains taxes when they sell a property. That's huge for someone who's, say, looking to upgrade or even downsize.
Yeah, I've seen it firsthand. There was this client of mine, let's call him Tom. He owned a rental property that he had for years, and it had appreciated significantly. He was worried about the tax hit if he sold it.
I can imagine. That can be a big deterrent for a lot of people.
Exactly. So we talked about the 1031 exchange, and he ended up selling that property and reinvesting in a multifamily unit with better cash flow. Not only did he defer taxes, but he also increased his monthly income.
That's a win-win situation for sure. And I think it's important to note that for many over 40, there's also the emotional aspect of financial security.
Absolutely. It's not just about the numbers, it's about peace of mind, knowing you've got a solid plan in place.
Right, and as people think about passing wealth down to their families, understanding these strategies can make a world of difference.
Definitely. I had another client, let's say her name is Lisa. She was looking to sell her family home and was worried about how to pass that wealth on to her kids.
That's a common concern.
Yeah, and we discussed using a 1031 exchange to sell her property and invest in something that would generate income, which could then support her lifestyle and still leave something for her kids later on.
That's a smart move. It's so important to think about the legacy we leave behind.
For sure. Plus, with the current economic trends, we're seeing shifts in the market. Interest rates, for instance, have been fluctuating, and that can affect property values.
Right. And if you're sitting on a property that has appreciated significantly, it might be a good time to consider taking advantage of that through a 1031 exchange before the market shifts again.
Exactly. Timing is everything. And for those over 40, it's crucial to have a strategy that aligns with their retirement goals and market conditions.
And let's not forget about the potential for diversification. If someone has all their investments tied up in one property, a 1031 exchange can allow them to spread that risk out a bit, right?
Oh, absolutely. You can transition from a single-family home to a portfolio of smaller properties or even commercial real estate. That can help mitigate risk and increase income potential.
And the income generated can be reinvested or used for living expenses during retirement, which is a big relief for many people.
Right. Plus, with the way the economy is trending, having that extra income can buffer against unexpected expenses that come up in retirement.
Yes, and, I think the emotional side of this is often overlooked. Selling a home or an investment property can be stressful.
It can be. But knowing that there's a strategy like the 1031 exchange in place can alleviate some of that stress. You're not just selling. You're making a smart move for your future.
Exactly. It can transform the way someone approaches their financial situation. Instead of feeling trapped or anxious, they can feel empowered to make decisions that align with their long-term goals.
And that sense of empowerment is so important, especially as we age. We want to feel in control of our financial destinies, right?
Definitely. And with property values being what they are, it's also a great opportunity to capitalize on what you've built over the years.
For sure, and let's not forget about the potential tax benefits down the line. If someone is strategic about how they structure these exchanges, they can really maximize their wealth over time.
Yeah, I think that's a critical point. It's not just about deferring taxes now, but creating a more sustainable financial future down the road.
Exactly. And as we look ahead, it's clear that navigating these waters requires a bit of foresight.
So true. With all this in mind, it's essential to have a game plan, especially in today's shifting economic landscape.
It really is. And that brings us to the next part of our discussion, where we can dive into some practical strategies for implementing a 1031 exchange effectively.
Perfect! Let's get into that.
So Sarah, let's dive into some of the core strategies and rules of thumb that can really help our listeners get a better grasp on the 1031 exchange, right?
Absolutely, Mike. It's a powerful tool for deferring taxes when selling investment properties, but it can seem a bit overwhelming at first. Where do you think we should start?
Well, I think a good starting point is understanding the basic requirements of a 1031 exchange. There are specific timelines you need to follow. For example, once you sell your property, you have 45 days to identify a potential replacement property and 180 days to close on it.
Right, those time limits can be a bit stressful, especially if you're new to the process. So what's a smart way to approach identifying those replacement properties?
A common rule of thumb is the 3-property rule. It allows you to identify up to 3 potential replacement properties, regardless of their value. This gives you a bit of flexibility, especially if you're uncertain about the market.
That makes sense. But what if someone finds a great property that's worth more than 3? Can they still go for it?
Yes, they can. There's also the 200% rule, which allows you to identify more than 3 properties, as long as their total value doesn't exceed 200% of the value of the property you sold. It can be a useful option if you're looking at a broader market.
Got it. So more options can lead to better choices, but it's all about knowing those limits, right?
Exactly. And once you've identified a property, it's crucial to do a solid evaluation. One of the key metrics I recommend is the quote, 1% rule. This means that the monthly rent you can expect should be at least 1% of the purchase price.
So if you're buying a property for $300,000, you'd want to see at least $3,000 in monthly rent?
Right. That's a good benchmark to ensure you're not overpaying. Another important metric is the quote, 50% rule, which suggests that about 50% of your rental income will go toward operating expenses. So if you're expecting $3,000 a month in rent, you should budget around $500 for expenses.
Those rules really help paint a clearer picture of the financials. But how do you determine if a property is a good investment overall?
A helpful tool is the cap rate. It's calculated by taking the net operating income, which is your income minus expenses, and dividing it by the purchase price. A higher cap rate usually indicates a better return on investment.
Can you give us an example of that?
Sure. Let's say you purchase a property for $500,000 and it generates $50,000 in net income after expenses. So you divide $50,000 by $500,000, which gives you a cap rate of 10%. Generally, a cap rate above 8% is considered a strong investment.
That's really helpful. It sounds like these metrics can guide you in making informed decisions. But what about financing options?
Great question. There are a few financing strategies you can consider. Traditional financing is common, but you might also explore options like seller financing or even partnerships.
Partnerships, huh? That could be a game changer for someone who might not have enough capital on their own.
Exactly. Partnering with someone can provide access to more resources and decrease the financial risk. Just remember to have clear agreements in place to avoid misunderstandings.
Yeah, communication is key. Now, what about property types? Are there specific types that work best for a 1031 exchange?
Typically, investment properties qualify for a 1031 exchange. This includes residential rentals, commercial properties, or even raw land. The main thing is that they must be held for investment or productive use.
So no flipping houses for a quick profit then?
Correct. Flipping properties might not qualify since they're usually held for a shorter time frame. It's about long-term investment, which aligns with the 1031 exchange goals.
And speaking of long-term, what markets should someone consider when looking for replacement properties?
That really depends on your investment strategy. Some investors prefer emerging markets with high growth potential, while others stick to stable, established markets. Just remember to research local job growth, population trends, and rental demand.
Those factors can really highlight whether a market is worth the investment.
Right, and as you're evaluating properties and markets, keep a checklist handy. It should include things like property condition, location, rental demand, and your financial metrics, cap rate, cash flow, all that good stuff.
Sounds like a solid approach. It helps keep everything organized and ensures you're not missing any crucial details.
Exactly. It's all about having a systematic way to evaluate each opportunity.
But, even with all these strategies, I imagine there are still some common pitfalls to watch out for.
Oh, definitely. It's easy to get caught up in the excitement and overlook some key elements. For instance, not properly vetting replacement properties can lead to costly mistakes.
That's a big one. I guess rushing the process can be tempting, but it's essential to do your homework.
Absolutely. And another pitfall is failing to meet the timelines for the 1031 exchange. Missing those deadlines can mean losing the tax deferral benefit, which is a huge setback.
Wow, I can see how critical it is to stay organized and on top of those timelines.
For sure. And one last thing to consider is the potential for over-leveraging. It's great to finance properties, but stretching your budget too thin can lead to financial strain down the line.
That's a good reminder to balance ambition with caution.
Exactly. It's great to aim high, but you want to ensure you're building a sustainable portfolio.
Well, I think we've covered a lot of ground here. It's all about understanding the tools available, evaluating properties wisely, and avoiding those pitfalls.
Couldn't have said it better myself. It's a journey, but with the right strategies, it's definitely manageable. As tempting as it is to think that a 1031 exchange is a magic bullet, there are definitely some common pitfalls that investors can fall into.
Right, like over-leveraging. That's a big one, isn't it?
Absolutely. I've seen investors get so excited about the potential of a new property that they end up taking on way more debt than they can handle. It's a slippery slope.
Yeah, I can imagine. So what happens when someone over-leverages?
Well, let's say you buy a property with an aggressive loan. You're hoping for high returns, but you forget to factor in all the other costs. If your rental income doesn't cover your mortgage payments, you could be in a really tough spot.
Ouch. That sounds stressful.
It really can be. I remember a client of mine. He bought a multi-family unit, convinced he could increase rents and cash flow. But the repairs, maintenance, and unexpected vacancies ate into his profits. He was barely breaking even, and that's before any of the loan payments kicked in.
So it's like a domino effect, right? One mistake leads to another.
Exactly. And then there's the issue of bad tenants. You might think you've done your due diligence, but sometimes people slip through the cracks.
Like what kind of things should investors be looking out for?
Well, I've seen cases where landlords skip a thorough background check. They might be desperate to fill a vacancy quickly. But then, a few months down the line, they're dealing with late payments, property damage, or even evictions.
That sounds exhausting.
It really is. I had a client who didn't check on rental history. They ended up with a tenant who paid rent inconsistently and was a nightmare to manage. It can really drain your time and energy, not to mention your finances.
So what's the key takeaway there?
Always vet your tenants thoroughly. Look for consistent rental history, references, and don't skip the background check. It's worth the effort up front to save you headaches later.
Definitely. And what about ignoring cash flow?
That's another huge pitfall. A lot of investors get caught up in the excitement of property appreciation, but they forget to pay attention to the cash flow.
Right. It's not just about what the property is worth, but also how much it brings in every month.
Exactly. I had a friend who bought a property in a hot market. He was so focused on the potential value increase that he didn't consider the cash flow. After a year, he realized he was losing money because the rent barely covered his expenses.
Wow. That must have been a wake-up call.
For sure. And it's easy to get caught in that trap when everyone around you is talking about market trends and property values.
So how can investors avoid that pitfall?
It's all about running the numbers. Before you buy, make sure you have a clear understanding of your cash flow. Factor in all expenses. Mortgage, property management, maintenance, everything.
That makes sense.
Another common mistake is trying to time the market. Investors often think they can predict when the right time to buy or sell will be.
Yeah, that's a tough game to play.
It really is. I know someone who waited for what they thought was the perfect moment to sell. The market dipped right when they were ready, and they ended up missing out on a better profit.
That's tough.
It's so unpredictable. Instead of trying to time the market, I always advise investors to focus on their long-term strategy.
That's solid advice.
And then there are hidden costs. Many investors don't realize how much extra expenses can pile up.
Like what?
Well, things like closing costs, maintenance, and even property taxes can add up. A friend of mine bought a property thinking it was a great deal, but after factoring in all the hidden costs, it turned out to be much less profitable than he anticipated.
So how can you spot those red flags early?
Get a good inspection before you buy, and always do thorough research on the property's history. Look into the neighborhood, understand the local market, and talk to other investors if you can.
That's a great idea.
And remember, it's okay to walk away from a deal that doesn't feel right. Trust your instincts.
Absolutely. So if someone has already made some of these mistakes, what can they do to recover?
Well, first, it's important to take a step back and assess the situation. Look at where things went wrong, and then make a plan to move forward.
Like maybe reevaluate your investment strategy?
Exactly. You might need to adjust your goals or consider selling a property that's underperforming.
And, of course, learning from those experiences is key, right?
Yes! Every mistake is a learning opportunity. Surround yourself with knowledgeable people, whether it's mentors or advisors, and don't hesitate to ask for help.
That's so important.
And remember, building wealth through real estate is a marathon, not a sprint. It's about making informed decisions and staying the course, even when things get tough.
Well said. It's all about the long game.
Exactly. So let's talk about some immediate steps you can take if you're considering a 1031 exchange.
Definitely. It all sounds so technical, but it's really about making it work for you, right?
Exactly. One of the first things you can do is get familiar with the process. A good starting point is to read up on the IRS guidelines for 1031 exchanges. They have a lot of resources online that can clarify the rules.
Yeah, and that can feel a bit overwhelming at first, but just take it one step at a time, right?
Absolutely. And then, if you haven't already, you might want to connect with a qualified intermediary. They're essential for facilitating the exchange. It's not something you want to DIY. Trust me.
Right, and you can usually find a list of qualified intermediaries through real estate associations or even your local realtor.
Yes, and don't hesitate to ask for recommendations from people you trust. Also, start gathering your financial documents. Having your current property's info, like its value and any potential gains, will be super helpful when you're making decisions.
Great point. And what about tools? Are there any apps or websites you'd recommend?
Definitely. Zillow is a classic for property values, but also check out BiggerPockets. They have calculators specifically designed for real estate investing, including 1031 exchanges.
Oh, I love BiggerPockets, and I hear they even have forums where you can ask questions and get advice from experienced investors.
Exactly. And if you want to crunch numbers on potential deals, the Deal Check app is fantastic. It helps you analyze properties and can even calculate various metrics for you.
That sounds super useful. What about rental properties?
For rental analysis, Rentometer can help you figure out what properties are renting for in your area. Getting a clear picture of the rental market can help you decide on your next investment.
And local MLS access can be a game changer too, right?
For sure. It gives you insights into recent sales, average days on market, and more. Being in tune with your local market is key for making informed decisions.
I can see how that would help a lot. What about habits? Any small actions folks can start taking right now?
Absolutely. How about committing to analyzing just one deal a week? It doesn't have to be a massive property. Even a small condo can teach you a lot about the market.
That sounds manageable. And you could also join a local real estate meetup. Networking can open up so many doors. Plus, you learn from others' experiences.
Yes, and those meetups can be surprisingly supportive. You might find mentors or even partners for future deals.
And speaking of learning, Are there any books or podcasts you'd suggest for people looking to dive deeper into 1031 exchanges?
For sure. The ABCs of Real Estate Investing by Ken McElroy is a solid read, covering the fundamentals, including tax strategies. And for podcasts, I'd recommend Bigger Pockets podcast. They have episodes focused on 1031 exchanges too.
Great suggestions. And I think it's so important to remind ourselves that it's okay to start small. You don't have to jump into a huge project right away.
Exactly. Just take that first step. Maybe even set a goal for yourself, like attending one real estate event per month or reading one chapter of a book each week.
That's a great approach. It's all about building momentum, right?
Yes. And remember, every little bit you learn and do brings you closer to your investing goals. It's a journey, not a sprint.
So those are some practical first steps. Now let's bring this all together.
Well, Sarah, as we wrap up our discussion on the 1031 exchange, it's clear there are some key takeaways for our listeners.
Absolutely, Mike. First off, the 1031 exchange is such a powerful tool, right? It allows investors to defer capital gains taxes when selling a property, which can really maximize your investment potential.
Exactly. And then there's the importance of identifying replacement properties within that 45-day window. It's critical to be prepared so you don't miss out on those opportunities.
Right. And let's not forget about working with a qualified intermediary. They can really help navigate the complexities of the exchange, making the process smoother.
And, it's all about long-term strategy too. This isn't just a quick fix. It's about building wealth over time. The 1031 exchange can help you level up your real estate portfolio.
Yeah, it's an exciting way to keep your investments growing without the immediate tax hit. It really emphasizes the idea that real estate investing is very much about planning ahead.
Definitely. And for anyone over 40, this can be a game changer. Building wealth through real estate is not just a dream. It's something you can actively work towards.
Speaking of which, if you found today's episode helpful, we'd love for you to like and subscribe. And please share your biggest takeaway or any questions you have in the comments.
And don't forget to share this episode with someone who might be interested in investing in property. You never know who might need to hear this.
Next time, we'll dive into another intriguing topic, depreciation and how it can lower your tax bill. It's going to be so informative.
Absolutely. I'm looking forward to that one.
Thank you all for joining us today. Remember, every step you take in real estate can lead to lasting wealth.
Until next time, take care, everyone.
Bye for now.